This is the video lecture for chapter number 8, where we're going to learn the tax rules for forming a new corporation. Keeping in mind, back in chapter 5, we already were doing tax returns for an operating corporation. So we're kind of taking a step backwards here. Maybe you have an existing business run through a sole proprietorship or even a partnership, and now you want to incorporate that business or just start a new business. So that's what is covered here at the beginning of chapter number 8, forming a corporate entity. Now, once you have one or more corporations or one or more lines of businesses running, maybe you want to reorganize the legal structure of those businesses. And eventually, when you want to terminate that business or corporation, that's called a full liquidation versus just dividend distributions or partial liquidation that we had learned back in chapter number 7. Now, before we take a look at the details, let's clarify a couple different terms. So I think I had done this example back in a previous chapter when we were talking about um, value or equity. So the easiest one to relate to is maybe your home, your house. So either your house or your parents' home or someone's home, they had bought that home at a specific cost. The tax term is called basis or adjusted basis. And they want the value of that home to increase. Uh, Unless you're talking about real property taxes, yeah? For real property taxes, they charge you based upon the value. So if you don't plan to sell that property, you want the value to stay low, to pay low real property taxes. But if eventually you want to sell the property, you want the value to increase. So financial accounting calls this fair value. The tax term is called fair market value. So here it's increasing compared to your original cost. So the difference would be a gain that you have earned. But you're not going to report it because you haven't sold the home yet, the property yet. So we would call this gain unrealized. So really that's one of the terms mentioned a lot in this chapter. Not unrealized, but just realized. But in our case, this gain or even possible loss if the cost is more than the value is not triggered yet. It's unrealized. So eventually, if the property increases and you're planning to move, you want to sell the property or exchange the property. Sometimes those two terms go together, sale and exchange, sale or exchange. At that point, this gain or loss will be realized. Okay? Now, there's something economically you're better off or maybe worse if it's a loss. So the next question is this gain taxable or is the loss deductible? Instead of the word taxable or deductible, we can use the word recognize. Do we recognize the gain? Do we tax the gain? Or if there's a loss, can we deduct the loss? Recognize the loss? Well, for the case of losses, you cannot deduct losses on the sale of personal use property. Again, something like your home here. Or, I think it may be covered in a previous class, if this is your personal residence and you've lived in it for 2 out of the past 5 years and you own it, title, then this gain will be unrecognized, not taxable, at least to the extent of a gain of 250,000 for an unmarried individual or married filing joint. You can exclude $500,000 of gain. Even though it's realized, you don't have to recognize or report it as taxable. So another term maybe that's mentioned for unrecognized or postponing the gain is called deferral or deferred. Okay, so in this chapter number 8, we're dealing with stock of a corporation and also other property. And when you transfer the stock or other property, that is a sale or exchange. And that means there's going to be a realized gain or loss. And again, the question is, do you recognize the gain or loss? Or can you postpone that gain, defer it to be unrecognized until another transaction later on? Okay. So let's talk about forming a new corporation. The Internal Revenue Code section that we're dealing with is called Section 351. So that's a popular number for tax accountants. Every time you create a new corporation, you want the transaction to be tax deferred, yeah? No, not recognizing a gain. Okay, so you need to meet the requirements here. So basically, the shareholder is contributing cash, that's the easiest thing to contribute, or contributing other property into this new corporation. And in exchange, they're getting back stock of that corporation. Even though the property has a high value and maybe low cost basis, they're getting back stock equal to the value of that property. But you're not going to report any gain under this section 351 if all of the shareholders who are contributing at this time will own 80% or more control of that corporation. Okay, so we're possibly realizing a gain on the transfer of this property. No gain if it's just cash being contributed. But if it's an existing business you're transferring into the corporation, there is possibly appreciated property higher than the cost basis or adjusted basis. And you have a realized gain. But the gain will not be recognized. It will be deferred until you sell this stock or exchange it for something else. There's always exceptions to that general rules, yeah? And what we just covered was a general rule. Gain could be recognized to the extent the shareholder gets property back from the corporation other than stock. That other property is called boot. And to the extent the shareholder receives boot, they may have to report a gain or recognize the gain. Notice here that losses are never recognized here when you incorporate a business. Again, boot may trigger the recognition of gain. Boot is things the shareholder gets back that's not stock in the corporation. So here we're trying to figure out what is the cost basis of the stock that the shareholder is getting back. So we add up the cash contributed by the shareholder to the corporation. We add any other properties cost basis, other property other than cash. And then if there was boot, there would have been gain recognized, and that gain amount is also added here to the other amounts. But we're going to just back out whatever boot that was received, so these two kind of offset each other here. We also reduce the cost basis by any liabilities assumed by the corporation. A liability of the shareholder now assumed by the corporation. So the typical situation would be a property, here other property like a building or land, and then there is a mortgage on that property now being assumed by the corporation. So the total down here is equal to now the cost basis of the stock. So eventually when the shareholder sells the stock, they can deduct this basis here. So in this table, we're trying to figure out now what's the cost basis of the property in the hands of the corporation. So cash is always going to be whatever face value it has. That's its cost basis. Plus the cost basis of the property that was in the hands of the shareholder will, the term is called carry over to the corporation. Let me take a step back here to the previous table. You see this basis of the other property that was transferred to the corporation? Now it's going to stick to the stock basis. We call that substitute basis versus the carryover basis to the corporation, the assets now held by the corporation. And what's a little strange is here is the shareholders' gain. But what we're trying to figure out is the cost basis of the property to the corporation. But that gain recognized by the shareholder, not realized but recognized, taxable, can be added to all of this costs to the property now the corporation has. So whatever, again, face value of cash you have, $1 is going to be $1 basis. And the remaining basis has to be kind of allocated among this other property based upon its fair market value. So let's say that the shareholder wants to help its existing corporation it owns, stock that it owns in the corporation. But it's not going to take back any more stock. It's just going to make an additional capital contributions. So basically, the corporation is just going to take over the basis, again, carry over basis of the shareholder now to the corporation. And the shareholder is just going to increase the basis of their stock. Again, no additional stock is being issued here, but you gotta be an existing shareholder, and generally this is a tax-free or tax-deferred transaction. So on the opposite end of a corporate life, or at least the shareholder's interest in the corporation, the shareholder wants to sell or dispose or get rid of, or maybe the stock is now worthless. The general rule is stock is a capital asset. And when you sell or dispose or exchange a capital asset, you get a capital gain or loss. And if you held the stock for more than a year, it's going to be a long-term capital gain or loss. And we know that long-term capital gains are good, gets taxed at lower rates. Long capital losses, not so good because you only can offset the gain and maybe another $3,000 of ordinary income, or you get to carry over any unused capital losses to offset capital gains in future years and another $3,000 of ordinary income. But to help business owners, really small business owners, small meaning under $1 million of stock cost basis, and to help the original incorporators, shareholders, if they held the stock for more than 5 years, and the business was run, the corporation was run as an active trade or business, and they suffer a loss. The loss is not going to be a capital loss, but it's going to be treated as an ordinary loss, offsetting not just capital gains, but also ordinary income without this $3,000 limit per year. Here up to $50,000 or $100,000 for married filing joint. No special election is required. You just have to qualify with all of these items here when the shareholder does dispose of their shares or the shares become worthless. So let's talk about acquiring an existing business, either an individual acquiring a corporation or a corporation acquiring a corporation. So if you look at this table here, there's possibly two different things you can acquire. Well, first, going through some of the names here, The continuing example in our textbook is Spartan Cyclery and Repair, a corporation, and they're thinking of now expanding and buying another similar type business, this Wolverine Cyclery and Repair. And the shareholders of Wolverine, or one shareholder is, the only shareholder is Pam. So in this column here, Spartan is considering to buy the assets owned by the corporation Wolverine. Or in this column here, Spartan is considering to buy the stock owned by Pam, the Wolverine stock owned by Pam. This taxable role here is referring to not the tax to Spartan, but the tax to Wolverine or the tax to Pam. It's not going to be taxable to Spartan in any case here if they're acquiring the assets or the stock through cash or stock of Spartan. Remember, you cannot recognize a gain or loss when you deal with your own stock. Yeah. Now, if I were Spartan, what I would want to do when I expand my business, I want to buy the assets of Wolverine so I can get a step up in basis in those assets. I can buy inventory at a high cost, and when I deduct it, I have a smaller profit and pay less taxes. Or when I buy equipment and building at a higher cost, a step up in basis, I get a bigger depreciation, reducing my taxes. But you know what? It's going to be taxable to the selling corporation, Wolverine. They're going to pay taxes now. And now, in the other three situations, it's not going to get that benefit to Spartan. They're not going to get a step on basis in the assets they're acquiring, either directly of acquiring the assets themselves here, or indirectly through the stock of Wolverine. So in this case here, you're going to buy the shares of stock from Pam, and Pam is going to have to pay a tax on it. But the underlying assets in Wolverine stay the same at a lower cost. Or down here in this bottom row, we're going to acquire the assets or the stock. But in either case down here, the assets stay at the low cost as if it's still in Wolverine. Okay. So if you want it to be tax-free to the target or the shareholders target, you want to use this row down here. Sometimes we call it reorg. And there's different types of reorg. Here's a type A, basically acquiring the assets of the target corporation and not the corporation itself. Or here type B, where you're acquiring the stock of the target corporation. Okay? And we'll go through these letters a little later. Here's a reminder of what we just covered. You can have the acquiring corporation either buying the stock of the target corporation or buying the assets of the target corporation. And it can either be taxable to the target or shareholders of the target, or can be tax deferred to the target corporation or the shareholders of the target corporation. In the case of a taxable asset acquisition, that's the best situation for the acquiring corporation because they get to step up the assets cost basis for the assets they're buying. Okay, that's good tax-wise for the acquiring. Not so good for the target corporation or the shareholder because they have to pay taxes. Or it can be tax deferred to the target or to the shareholder of the target. But in that case, the cost basis stays the same. Okay, it doesn't help the acquiring. at least tax-wise. Again, pretty much reminding us there's taxable situations. Here it says that it's common for big public corporations to use cash to buy um, a new or acquiring a corporation. That may not be true if there's no cash or very little cash held by the acquiring corporation. They definitely have stock of their own corporation to issue out, right? So you still can use that old section, I shouldn't say old, but the previously mentioned section 351 to acquire an existing business. So maybe here is Corporation A, Corporation B, and A wants to take over B. So they can form a new Corporation C. So the shareholders of A would put their stock in here, and the shareholders of B would put their stock in here, and they would take back stock of C. Okay, so now C would be the parent of A and B, and the old shareholders now would be just shareholders of C. This is a new corporation, and as long as the shareholders have control, remember 80% or more ownership, then this is a tax deferred transaction. Or I guess maybe the bulk of this chapter deals with other ways of acquiring a business or reorganizing the business, hopefully through a tax deferred transaction. And we'll go through some of these reorganization types. Reorganizations under the Internal Revenue Code can be used for acquiring existing corporations or businesses and even disposing or splitting up or spinning off existing businesses or lines of business. And again, hopefully you can defer the tax when you do that. So this is the actual Internal Revenue Code. So we just seen section 351, incorporating tax deferred, or getting ordinary losses on the disposition of small business corporations under section 1244. So this section 368 deals with reorganizations. And reorganizations are identified by letter type. So let's see if I can zoom in here. My pen doesn't work when I zoom in. So our textbook talks about an A type. So you can see this A. I don't know if you can see my mouse here. The A is called, and it's the most popular type, called a statutory merger. Statutory means law. And the law we're referring here is not tax law, but the state law in which the corporation was incorporated. Like here it would be Hawaii corporate law. And if you can meet the requirements here under the state law, and also some other principles mentioned that we'll see in the next video called continuity of interest and business enterprise, then it can be tax deferred, at least most times, under this type A reorg. I kind of remember A is the letter that starts off with the word for the word asset, right? You're acquiring the assets of the target corporation. And a type B, you're acquiring the stock of the target corporation. I don't know if the B kind of, you can superimpose a letter S on the B there. You're purchasing or acquiring the stock of the target corporation. C is like a type C is like maybe a A, but it's more restrictive. It has to be solely. B is also solely, but A is also solely stock also. So A would be the most common, yeah, in acquiring or merging together other businesses. At the bottom is a type D, and I remember D is dividing or divisive type. You're splitting up or splitting off existing subsidiaries or existing lines of business. In other words, you're making the corporation smaller. Okay, so let me stop here. When we come back, we'll take a look at some of these specific uh, reorganization types.